Happy Thursday and good morning. We're so glad you came back for our third day, which you will not want to miss because we have an incredible lineup planned for you, including some of my favorite sessions.
Well, I think day three is going to be very, very exciting. I mean, right off the bat, we start with two of the leaders in two very different segments of the industry. We've got Clara Farley, a close friend of mine who works for one of the leading private equity energy houses, KKR. And then Dave Stover, another good friend who just took over as CEO of Noble Energy here in the last year. So they'll offer a great perspective of how private equity is funding the industry and how one of North America's, if not the world's leading exploration companies, Noble Energy, is dealing with the challenges and the opportunities that we see before us today.
As we move into our third and final day of conference, I think that some of the heaviest hitting panels are in this day. I think what's amazing is to think about how our world has gone from connected to hyper-connected. And what we're really focusing on today is how Colorado and the Rockies are interweaving with the rest of the world and having serious geopolitical implications on energy markets, energy policy, and energy dynamics worldwide.
How do the Rockies fit into the global energy puzzle in the next 5 years? I think like any business, you have to find your niche. And what will the Rockies niche be in a changing time? It used to be Rockies gas was providing supply to the Northeast. Well, now with the Marcellus and the Utica, the East Coast really doesn't need Rockies gas. So how do we find our niche and make sure we're the best supplier of, for instance, natural gas to California? And how do we get LNG exports so we have a market for our gas long term?
Well, day three of the conference, this is the final piece of the puzzle, and this is the important thing for us to understand. Obviously, we need that global understanding of the marketplace, but now we need to understand how we fit in and how what we're doing here in the United States, here in Colorado, and this region fits into that broader economic and global picture.
Good morning, welcome back. I see that you made it in from your wanderings and poor choices of Wednesday night, so I'm glad to see you. This is the third day of the Global Energy Puzzle Conference, and it's not often, particularly in either very busy or very challenging times, that we get to attend to spending time on how we're going to advance, how we're going to grow both as individuals and as organizations and as an industry. And so I really encourage you, since you are here today and we have a really spectacular lineup of thought leaders and thought leaders who are in organizations who are willing to be innovative and interesting, that you spend today contemplating what your role is and what you can bring and offer to the transformation of the industry as we know it. So we began on day one looking at global geopolitics, at global markets, at how the big picture of the global energy puzzle is both responding to and informing the price environment, and how geopolitics are informing how those things are interplaying. Yesterday, we moved down into national politics, national policy, and what we as an industry can do to be a part of some successful resolution of those things. And today we're going to get more granular. This is the third day where we hear from individuals who are really interesting and have really thought about these issues, and they've thought about how we're going to position ourselves for the future. So this is a really unique opportunity to learn and to inform our own thinking about these things. So you do have the opportunity, in addition to paying attention, you have the opportunity to participate via social media. So we have our social media scroll going here, and you can have your minute of fame with hashtag RMES2015. I do want to take a moment to really genuinely thank our sponsors. In difficult times, we have still found that companies and COGA members are willing to invest in this kind of dialogue and this kind of coming together that continues to advance our thinking and our positioning for the future. So thank you to our sponsors who make this possible. I also want to acknowledge there's quite a few members of our steering committee here, and our steering committee is made up of volunteers that spend 11 months planning this conference. So it's like planning your wedding year after year after year. And we spend a lot of time, and I just want to thank our steering committee members who are here. Will you join me in thanking them? If you see Fred Julander today, I don't see him here right now, but he did found this conference 27 years ago, and I really want to honor his legacy on this third day by thanking him for creating an environment where we have conversations that don't happen anywhere else in the country. Okay, so with that, let's prepare you for this amazing panel that we have coming up. So introducing our next panel will be Peter D. I know Peter D needs no introduction, but I can't resist the opportunity to introduce him anyway. So he's the president and CEO of CERC Resources, which doesn't even begin to articulate the resourcefulness and success that Peter D has had. And yet, he is one of the most engaging, humble, thoughtful people that I have the great pleasure to work with year in and year out. He has a long history of fabulous successes, CEO of Western Resources, CEO of Barrett, successful sales. He was named Wildcatter of the Year. In addition to all that, somehow he manages to be involved in conference every year for over 15 years. But he's also this extraordinary adventurer and outdoorsman. And if you ever have a chance to have a beer with Peter D, you're going to really find yourself engrossed for hours in very interesting conversations. So I can't think of a better person to introduce our next panel. Please pretend you have 7 shots of espresso and you're willing to humiliate yourself with a really, really, really loud woohoo for Peter D.
Well, thank you very much, Tisha. Yeah, I was going to bring some 35mm slides from some of my past expeditions, but you can't even find a slide projector anymore. It's terrible. Well, it's a great honor for me to introduce 3 good friends and outstanding leaders from very different parts of our industry, but they're all interrelated, as you'll see here in today's panel. So from the private equity world, we have longtime friend and one of my strategic thinking confidants, Claire Farley from Kohlberg Kravis Roberts, commonly known as KKR. Claire and I had the pleasure to serve on the Encana board for many years, which is a real delight. She brings her expertise to us today from the private equity world, but also is a former executive of Texaco, and also she was co-president of Jeffries, Randall & Dewey. And she's grounded in geology, which is good, as well as her astute business background. Most important. Then from the public arena, we have Dave Stover, Chairman, President, and CEO of Noble Energy, of course, one of the premier E&P companies in the country, if not the world. I had the honor of welcoming Dave to the All-American Wildcatter Group this past April. So today, Dave is going to bring his domestic, international, and recent M&A activity to the forefront. And then we have Chris Hansen, who many of us know from the IHS and more recently Janys analytic days. He's been a great advisor on all this data compilation and bringing social media to the confluence of data and presenting that to us. Now, I used to think Chris had a little bit higher IQ than I've recently learned, because he had a slight dip in his IQ and decided to run for public office. But I think, in all sincerity, we heard Mayor White's call to action yesterday at lunchtime to draw more people out of our industry in public office, and I'm so glad Chris has taken one for the team, so none of us have to worry about that. So with all that, I'll turn it over to Chris.
All right.
Thank you.
Peter, thanks very much. Appreciate that introduction, and very happy to be with you this morning. Chance to have a great conversation on this third day of the KOGA conference with a couple of industry experts. We've got some great perspectives we're going to share this morning. And what I wanted to do, really, my job is just to keep things going for Dave and Claire. We're going to spend a few minutes getting things going. I got a few questions prepared here. Please take a moment to write down your questions as we go. We'll collect those and bring those up as we go through the panel. And really want to encourage audience participation in this. And let's go ahead and kick things off. I'd like to start with Dave. Dave, one of the key perspectives you bring today to the table is the breadth of the portfolio that Noble has around the globe. And I wondered if you might just kind of kick things off for us, talking a little bit about that portfolio diversification and how you think that helps you navigate the difficult waters that we're in now.
No, I appreciate it, Chris. And I think probably on a production basis, we've been probably 60% domestic and 40% international. But both have a big contribution. I think we've really benefited from a global, diverse asset base, both from product mix and just the differences that each one brings. I think the international asset base is very complementary to the domestic base in that our assets internationally take very low maintenance capital. They got steady volume. And really in this period of time, this commodity price world, they have the highest margins. So it's a good complement as you're looking at your domestic base where you have more ability to ramp up, ramp down, and see a quicker impact on things. So to balance how you make decisions, how you allocate capital, I think it blends very nicely. So we like that diversification, we like that mix, but it only works if you're good at both elements. So for us, it's been critically important to keep that proficiency in onshore development, offshore development, and then exploration, major project execution, because a lot of the new opportunities international really come through initially an exploration lens.
We'll spend a little bit more time on hearing some of the particulars there, but I think that's a good way to start our thinking this morning. Claire, let's come to you on the lens that you're bringing to the table this morning as a private equity investor. You know, we're in a very volatile environment, trying to figure out how to make progress in this environment. How has your approach changed as an investor? Are you reshaping your portfolio, making big adjustments, or is it more on the margin? Maybe share with us kind of your thinking as a private equity investor.
Yeah, thank you, Chris, and it's great to be here with both of you. Wow, what a time. Our fourth downturn in my career. And this one is different fundamentally because of the resource that we have in North America and the ability to accelerate that resource in a relatively short period of time. Mm-hmm. And that those decisions are being made by 700 individual companies. So it's very difficult for all of us to figure our way forward on this. So we have to go back to the fundamentals and say, where are we making a return? That's what private equity does, I would say, has the luxury of doing. And I mean, I'm sure everyone in the audience would say, oh, absolutely, I focus on returns as well. That's my number one driver. And I would say the behavior of the last couple of years of a lot of oil and gas players belies that. That they were not meeting their cost of capital. Debt was cheap. It looked good to load up on it. And now we find ourselves in a place where companies had modest leverage are now highly levered. So we are, as a private equity group, looking at those highly levered companies, some that we invested in, some that we want to invest in the future, and say, those are restructuring opportunities. There really is no way forward. Absent some snap in prices, and I don't think we find many in that camp today, those are restructuring opportunities. There's going to be lots of sales of assets as people go to shore up their balance sheet. So we hope to participate in that. We have a large fund that's dedicated to providing drill capital, low-risk drill capital, development drilling. We think that is going to be another good place to get invested behind the companies that have really proven that they know how to execute well.
Yeah. So both of you, I want to pick up on a thread that's come out already just in your first two responses, and that's the ability of the industry to respond much faster than it did, say, a generation ago or half a generation ago. I've heard it referred to as the Ferrari Effect, right? We can ramp this thing up or we can hit the brakes really quickly. Maybe just to expand on that a little bit, how has that changed operations at Noble? Let's maybe start there.
Yeah, I mean, just over the past week, I've been going around to all our offices and talking about first and second quarter results and what do we have to look forward to the second half of the year. And one of the things for us, we got the whole organization engaged very early in the year as you saw the downturn, as you expect. You don't know the duration of the downturn. I mean, you can hear everybody make speculation. The one thing I can tell you with certainty is we don't know the duration of this downturn and how low and how long it's going to last. So you have to get your business positioned to really navigate through that turbulence, no matter how long that lasts. And I think one of the things we did very quickly this year is we positioned ourselves on a capital outlook, if you will, to where we had a line of sight to kind of cash flow neutrality on a run rate, by the end of this year. And I think that's extremely important to, if you will, put it in the analogy of your home life, that you balance your checkbook and you quit drawing from savings. And once you can do that, you have confidence to do other things. I think what we've seen is the whole organization got very engaged into restructuring the costs of the company. That's operating costs, overhead, all those things that are your daily costs. And I've been extremely pleased that we were actually ahead of where I would have expected this. To your point of how quickly, once you focus on something, it starts to happen. I mean, we're ahead of, by far, on a cost structure where I would have thought we'd be by now. I talked about on the earnings call, we're back to, on an LOE unit cost basis, we're back to pre-2010 levels, which is amazing to be there in 2 quarters.
And what's the percent? Maybe just to give folks a...
That's down, I think if you look at the percentage relative to the same quarter last year, it's down 20%. Okay. So, I mean, that's significant, but it's what gives me the confidence that we can figure out how to navigate through this. I mean, it was interesting what Claire said about looking back at some of the downturns, because one of the things I did is I went back. I started in 79. I actually started in 79 up here in Denver with ARCO. So when you plot that up and you look through the oil price over that period of time, majority of the time we've been in a $40 to $50 world. The problem is the last 10 years we've been in a $70 to $90 world. And the challenge is there's a lot of folks in this industry, a lot of employees and so forth, that's the only world they've seen. So I think it's helpful to go back and remind folks from 84 to 2004, you put it in 2015 dollars, we were in a $40 to $50 oil price world and the industry still thrived. We figured out how to adapt and make it work. And I think that's what you're seeing the industry focus on now.
Yeah, much sharper, much more efficient.
Yeah.
All right, Claire, do you want to talk about that Ferrari effect a little bit, how it's changed your approach?
Well, I think it's not unique to us, certainly. But what we saw was a dramatic efficiency improvement, first on the drill side. And we think that's, we were watching it, but it exceeded what we thought the industry would be able to do, and it's continuing to do so. So you can take half the number of rigs for the deliverability rule of thumb that we had in the past, and it's probably going to get a little better from there. And then the next thing that we're focused on is we believe that probably 40% or so of the stages are ineffective. And this is another place where people are now going to have the time and the incentive to really focus on when I complete that well with this many stages, this much sand, water, et cetera, how am I maximizing the value of that rather than trying to figure out how to keep up with the number of rigs that you're running. It was a logistics challenge before. Now that there's going to be a focus on efficiency, and we think that too may surprise to the upside in terms of efficiency. So that's a long way of saying we're not betting on a price recovery, to Dave's very good point. If it comes, that would be great. I can make lots of macro supply-demand arguments that would get us back to that. But I worry that every time there's a strong price signal and an ability to hedge into 70, that we are able to pick up, 500 rigs and create an oversupply problem again. So I really do think that it's going to be about, as it has been in long past, the best teams in the best rocks, working on the margin, working on what margin they can create for themselves.
No, I agree. I mean, just to add to Claire's point on the efficiency, I mean, one of the things we've talked about is with 4 rigs now in the DJ Basin, we're drilling the same footage, the same lateral footage that we were drilling with 6 or 7 a year or so ago. I mean, it's a huge difference.
Right. Yeah, fundamental changes, and very fast, right? I mean, even over the course of a year and a half, things have shifted. Well, let's maybe kind of continue on this, talking about the market a little bit, and I wanted to get into M&A situation, and particularly, Dave, with the moves you guys have made recently with Rosetta. Maybe start us there, kind of walk us through your thinking. Why was this the right time? Why was that the right asset for you guys to pursue?
Well, I think it starts first. I'll go back to what I said earlier, where that the first thing is you have to have confidence that you've set your company up and are on the path that you can navigate through the uncertainty, volatility, turbulence, whatever you want to call it. So if you have that confidence, then you're looking at, have you prepared and done your homework to be able to act decisively when an opportunity comes up? Because when you look at it and you go back through, as Claire mentioned, we've got some history here of some different cycles. And if you look back at some of those cycles and you think about it, it was actually during some of those cycles that you were able to do the most to strengthen your company for the long term. So, we had looked at for, I'd say, the last couple years and been considering, okay, if an opportunity came up to add to our portfolio, where would we be interested? And that had pinpointed or narrowed it down to, for us, the Permian Basin and the Eagle Ford, for various reasons. And so we'd done our homework for a couple of years, we'd evaluated companies, and we kind of kept a priority list. And Rosetta had always been, over the last year, probably number 1 or number 2 for various reasons. Consolidated positions, high working interest, operated everything we were interested in. So it's things you could go in and control the pace and see the impact of the development based on what you could bring to the table. And when the market opportunity came up this year, we were prepared then. We were prepared to be able to jump in and take advantage of an opportunity and do it very quickly. Within 3 months, within 2 months we'd closed, and within 3 months we have everybody in place.
Yeah, it's remarkable.
So we were able to, because we'd done our homework, we were able to move on it quickly, we were able to understand the opportunity, and we were able to integrate it very fast.
Yeah. Let's take it over to Claire. So, do you expect a big round of this? Is there going to be a long cycle of M&A in front of us?
Should be, right? That's what happens in every one of the downturns. I think more of it would have already occurred, but for the debt problem. So a lot of the target companies, when you look at where their debt is trading, it might be at 80 cents on the dollar, 50 cents on the dollar. And if I merge it, then I've got a change of control with the debt, and the debt's going to be put to that merged company at 100%, 102%. And so it just fundamentally changes the total value that you're going to pay for the company. So there's going to have to be some restructuring of the debt for some of the mergers to take place. Now others, it's just going to be once we settle into a view, because let's face it, right now, there's just huge uncertainty, and that just puts so much sand in the gears in terms of the M&A market. The markets need to settle into a view of a range of prices and a range of costs.
Yeah. I guess one thing I'm curious about, and I don't know the answer, and I'd be curious, Claire's opinion even, but that last 10 years when we had the higher price, and it seemed like inevitably when a company was ready to sell, there was usually some buyer someplace.
Yes.
With the environment we have now and the extra, not just industry market pressure, but now we're seeing a dynamic of a global external market pressure. Yes. Is there potentially a scenario where there's not a buyer for every company?
I do think that it will be a remarkable buyer's market for those
Pick and
few
choose.
companies that have dry powder.
Yeah.
And whether that's they're, a public company with, enough cash and room on their balance sheet, or willingness to use their stock, or a private company with bringing private capital. We think we're going to see some combinations of the two, because it's hard to find the public companies in this environment that have a great balance sheet. So probably a good opportunity. But you're exactly right, Dave. The would-be buyers are all loaded up with debt themselves.
All right. Any future forward look for us for Noble? Should we expect more? Watch you guys closely.
Right now, we're focused on the operation, and integrating this acquisition. I think the workforce would probably revolt on me if I told them we had another one. and we don't. But I think you always have to be in that part of the business. That's why we have a business development team. We've actually added to the business development team now in the downturn where you don't have as much activity. We're actually able to provide some great overall business broader experience to some engineers and geologists by having them look at some different things. It's being prepared. Again, that doesn't mean we're going to do anything in the next 6 months, in the next year, but you have to do your homework, and a lot of times it has to be done a couple years in advance.
And being bold, right? I mean, in other words, it's hard to pull the trigger on things
right.
in this
You're
environment.
not always
That's the reason
popular
that I
when
think
you do that,
it
too.
goes a little more slowly. But, none of us, or I've never been able to pick the bottom. And intuitively, we know that prices are more likely to go higher from here. When, how much, okay, we can debate, but much likely to go higher from here. So now is the time to act. It's a question of, do you have the dry powder? And there's a nervousness.
Sure. I mean, it is that preparation, and to Claire's point, you have to act very decisively when you see the right opportunity. But you only have the confidence to do that if you're prepared.
Exactly.
Yeah, and have done the years of homework as you described. Right. This is not something that you move on in a couple weeks. Claire, let's spend a little bit more time on the restructuring and this cleanup that is going to have to happen, the kind of deleveraging and the restructuring of the debt. How do you think this is going to play out, say, over the next 12 to 24 months? Maybe walk us through what your expectations are.
Well, there are a lot of companies. I mean, I think the latest estimate is about a third of the companies that have taken some form of public debt, where their debt is trading below par, 80%, but a lot of them where it's trading at 20%. So that is the debt market signaling that a restructuring has to happen. To get on side with that, there are many players that have to come to a consensus. That's the debt holders, of course, the equity holders, the boards of the company, the management of the companies. And I think when we saw these flashing lights last year, when the prices first started to tumble, or let me say earlier this year, and everyone was worried about the spring redetermination, we kind of jumped the ditch. There was a forward curve that said 60, 65 is, around the corner. Service costs, lifting costs, capital costs are all coming way down. So and if I'm a lender, to a reserve-based lender, I have a secure asset behind my loan, and it's not in my best interest to push that company. I don't want to take it over if I'm, J.P. Morgan, commercial lender. So we, again, just said, well, let's drive on through. And this fall, what's happening is the regulators of these banks are saying, hang on, your loan may be fine. It may be secure, maybe under a little stress, but you might be okay. But the leverage of the company itself is too high. It's 4 times, it's 5 times. So your loan is with a group of loans that are underperforming. So you don't get to look ahead. We're going to call your loan perhaps underperforming. That causes the bank to hold more reserves. They don't like to do that. That harms their ultimate returns. So they'll be looking to restructure some of this for a different kind of money to come in and for them to reduce significantly, in some cases, their reserve-based lending. So I think this fall is really going to be the catalyst. And then I would add just, the personal perspective of you've got management teams that are out there working for nothing. I mean, by that, I mean they've seen their equity value go to, I would argue, zero if you look at where the bonds are trading, right? It's the bond market saying you have no equity value. So you can play defense for a long time, hoping that you can dig out of it, essentially working for the debt holders. And the management teams are very talented. They recognize that this is an incredible time in the market to get invested. So I think that they're going to be pushing too to, let's restructure.
Yeah, paddle harder.
Yeah.
But that balance sheet strength is so important.
Oh, yeah, it's everything.
We did some things earlier this year to even strengthen our balance sheet, and everybody had looked at us beginning of the year as having a really strong balance sheet, which we did. So, some were surprised we did some more things like raised equity earlier in the year to even strengthen it further. Well, the reason we did that was because we believed there was still more downside than upside in the market. And a lot of folks, I think, wanted to believe, as you saw that oil price creep back up towards 60 earlier this year, that, okay, we'd made it through the worst and it was starting to come back, and I guess we didn't believe that. So thankfully we were right as far as what we did to continue to strengthen that. But that's what gives you the confidence to look for opportunities.
Right. Yeah.
Create the
without
dry
that
powder,
balance,
as
she has put it. Yeah. No, it certainly seems extremely forward-looking at this point in the cycle.
Well, we're in a commodity business, and from time to time we forget that. We're lulled into a different sense after 10 years of, this is looking pretty good. And money was cheap. So it actually, made perfect sense at the time. But we never stress test. I remember thinking, well, we should see what the debt looks like if we have $70 oil. Oh, my goodness, right?
We blew past that pretty quickly.
So.
Not even a speed bump.
Yeah,
That's right.
yeah. And then meanwhile, natural gas prices have been low too. So remember when we first encountered this same problem on the natural gas side, we were able to pivot to oil and NGLs. And now there's really no place to hide.
We were looking this week, almost exactly a year ago, we were at $97 oil price and a little over $4 Henry Hub gas price. And to your point, we tend to focus on the oil price, but we had a very harsh winter relatively, and we still didn't bump $3 gas. So you have to watch both of those.
Let's switch gears just a little bit. I've got a couple more prepared topics I wanted to get to, and then we've got some great questions that have come up from folks in the audience. Kind of looking at Colorado specifically, and Noble and other big operators in the state, and some of the small operators in the state, very active and in the public policy realm, a lot of different moving parts and pressures going on right now. Over the last several years, and then we've got some things we're looking out for on the horizon. Maybe I wanted to just kind of throw this to Dave. What made you decide, what made the company decide to get so involved in what's going on the public policy side here in Colorado?
Well, we fundamentally believe you have to be involved. You have to be involved with the community, with the regulators, with the government, every place you operate. No different if it's Colorado, if it's Israel, West Virginia, Pennsylvania, now Texas. And for us, the biggest aha moment, if you will, was when, we were an operator in the Gulf of Mexico. And I remember after the Macondo incident, we kind of had to look around and see, you had two potential tacks you could take. You could take the tack that, it's everybody else's problem, we're doing everything right, and just leave us alone and we'll be just fine type of thing. Or you could take the tack that, no, we need to go in, we need to help, we need to solve problems, we need to be involved. And so we really went and worked with the regulators to help return the industry to work in the Gulf of Mexico. And so at that time, we were the first company to get a permit to return to work in the Gulf of Mexico. And that only happened because we got involved. And we said, we're going to help figure out what the solution is to return to work. And that kind of thought process and principle, if you will, has carried over to every place we operate. So in Colorado, when it became obvious a year or two ago that there was a big need for additional education, for public awareness, for just being out in the community and actually show more of a face in the community, let people know who we are, what we do, and what the benefit is for the community. I guarantee you, most people do not sit around thinking, what's the benefit from oil and gas development? If anything, they're listening to and thinking the other pieces. Yeah. But the reality is the benefit and the improvement from oil and gas development over the years and in the future has been amazing. Just in the whole change of quality of life out there. The impact that it's had on food supplies around the world, the impact that it's had on medicine, just access to low-cost, affordable energy, and how that's developed countries is just amazing. And somebody's got to tell that story. We need more people telling that story. I mean, everybody in here needs to be telling that story if you have an interest in this business. And so we got involved. We got involved. I mean, the governor's done a great job of bringing everybody together on both sides to go through, if there's an issue, let's bring it up, let's meet it, let's be transparent about what we're doing. I think the fear of the unknown is what always concerns everybody. If you're not aware of it, you imagine the worst. So the more you can be out in front of people and the more you can be transparent and show what do we do and arm people with the facts, you see it change. I mean, we saw a big change over the last year in just the polling of the public support for development in Colorado. Significant change just from being out and talking to people and educating people. And you see the same thing internationally. We have the same thing and same type effort in Israel, where you have a new industry, a brand new industry.
Well, and to follow up on that just for a second, so there's that kind of inbuilt skepticism, like, oh, the oil company's telling me what they want me to hear, type of thing, right? And it's tough maybe to break through and get the impact or to spread the facts and the information. Maybe share with us a few thoughts. How did you kind of break through that barrier? What was your approach?
A couple things. One, we got the whole business community involved, whether it's local community up in Greeley, local leaders, Denver leaders, state leaders, and laid out the information for them and then let them kind of carry forward with the message and the information. Because, I mean, the reality, that has way more impact. Somebody's going to listen to them way more than they're going to listen to me, for your exact point. Yeah. The other thing we did is we had what we called this ambassador program, and I know Ted Brown's out here actually started it for us in the office, and now we've moved it to our other offices, where we'd have the employees come in if they wanted to for half a day to a day, and just give them the information about the industry, what we're doing, what the benefits of oil and gas development are, and then essentially let them go out and talk to their neighbors, go out to, get involved with planning commission, get involved with school boards, that type of thing. It made a big impression on me when we had a council person from Weld County come down and talk to me. I think it's been about 2 years ago. And the point that was made was if the industry doesn't get involved in the local, I don't know if you call it politics or governing or whatever, you're just leaving it to the opposition because they will get involved. And as an industry, we cannot live in the world we did when I came into the business where you just did your job, concentrate on what you were doing, and figured everything else around you would work its way out. You have to be involved and engaged.
going to switch the lens, Claire, to you, the private equity side, and you think about above ground risk, maybe to recategorize it as above ground risk. How do you factor that into your investments?
You know, it's extremely important, and most of our investors are large pension funds, and they are very concerned about environmental health and safety issues, sustainability. So we actually go to great lengths to make sure we understand whether or not the operations are sustainable, whether or not that's a team that has best-in-class practices, because we think that, you know, look, it's an industrial business and accidents happen, but you can't be the investor that was behind something that the rest of industry would say, no, that is not best practice. And there are, you know, hundreds of little oil and gas companies, and we're only as good as the last headline. So I do think it's incumbent upon all of us to set a very high bar and be tough-minded about that. When we think about access risks, those are hard risks for us to price. We do our best to say, you know, so for instance, in the DJ Basin, great asset. You know, there's some assets that are available in areas where, you know, there is a moratorium. How do you price in the bet that you may get access in the future? Those are tough. We don't have the answer on that yet. But we're
show me
looking
the
at
discounted cash flow on that. That's
But that public trust only comes if they get to know you, and they're comfortable that you will live by and have responsible development, that you actually care about what's going on in the community too.
Yeah, and it's a marathon, not a sprint.
Right.
Yeah. Staying in Colorado, we've had a great question come in from the audience here around helping us put the DJ Basin in perspective. So let's stay on that topic for a second. Maybe Dave, start with you, kind of as you think about, you know, back to this big portfolio, international, domestic.
Yeah.
How does DJ rank? Where is it in your constellation?
I mean, for us, and we've prided ourselves on cleaning up our portfolio over I'd say the last 5 years, we probably sold $2 billion worth of properties that we considered non-core or things we weren't going to continue to invest in or somebody else could create more value out of than us. And for the DJ, you know, we've got 5 now, call it 6 or 7 core positions, and the DJ has always been at the top. You know, I saw some things. Some folks were at a conference yesterday, and they couldn't wait to show me this morning, Eric, out there, that, you know, when you look at the returns for the DJ, especially as you move into the oil window, you know, they're right up there with any of the premier fields in the country. So, I mean, I can't see it ever not being a core position for us.
All right. Give folks in the room something to smile about. Yeah, Claire, how are you viewing it from your lens?
Same, you know, so we spend a lot of time, as you would expect, looking at every one of the basins, and then not just the play, but where is the sweet spot in the play? What are those margins versus the tier 1, the tier 2? Noble's position, Anadarko's position in the DJ Basin is, you know, at the very top quartile of what's going to work. You know, I mean, has been working. I'm not sure anything works at $40. Show me something that does. But you know, it is, and it's still early days. I mean, the efficiencies that you all are generating there, you know, I think will continue to flow. You know, the Rockies may have some other good plays that we're watching for longer term. You know, the Mowry Shale is, you know, a really important source rock in the Powder River Basin. That ought to eventually get included in the stack. So the Piceance just keeps getting better. So there's a lot to be optimistic about, frankly, in the Rockies.
And I think it really helps, and there's a few of us that have, I mean, not just us, but some others, that have some very large contiguous acreage positions in the DJ. You were able to put large acreage positions together back to back.
Yeah.
And that provides what we see a real benefit, especially in navigating through some lower prices, but whatever price environment, where you're able to do longer laterals, so you have less of a footprint on the surface, and you're able to integrate facilities. You know, you're able to put a central facility in, which I think for the landowner's standpoint too is a huge benefit.
Yeah. Well, and to pick up on that topic, I mean, you were kind of talking about best-in-class operators. I've often talked to people about kind of best-in-class regulation. I think Colorado has been, you know, ahead of the curve on many things. You look at, say, the methane regulations that came in recently that are well in advance, I think, of many other states, and you know, the water monitoring, et cetera. Right? There's a lot of pieces that are part of that puzzle. But what I hear you saying is that, you know, DJ is still very attractive, even though, you know, the regulatory environment is perhaps, you know, ahead of other states. How do you think about that? Is that are we close to some sort of tipping point? I mean, or is it, you know, DJ stayed pretty competitive in even with the more advanced regulation?
Yeah, I mean, I think from the regulation standpoint, that's again where you have to be involved in that process. You know, we worked with some of the other operators up here, and actually one of the environmental groups on the air rules with the government and so forth. And, you know, that again was about what's the right thing to do to get out ahead of something. And I think it's paying off now because we're out ahead of that.
Yeah.
And I think that's beneficial. But you have to understand that and build that into what that expectation is in your development plans.
Yeah. Any thoughts from a private equity lens on
Well,
kind
not
of the
so much
different
from
regulatory environments?
from a private equity lens, but as just somebody that, like Dave, has been in this business a long time. I'm gratified.
You said I was old, Claire. Is that what you
we
just
both
said?
are, Dave.
Okay.
We're both really old. But I remember, say, in the first half of my career, the first 20 years of my career, that I would say we had a little bit more of a bunker mentality as an industry. And I mean, shame on us, right? Because we were going to battle things out based on our ability to have the law on our side, and, you know, I mean, things that we could just kind of, you know, push our way through. And I think certainly in the last decade, with leadership from people like Dave and Peter D. and others, we have engaged with the communities. We say we have genuinely taken the attitude that we are able to operate when the community lets us. So, and we have fundamentally always understood that we've been very great at continuous improvement. So the footprint has continually been minimized. The standard to which the industry holds itself keeps increasing, and we weren't telling that story. We were not earning the public's trust, and I think this shift in the leadership approach, I think is really the only way forward for both the communities and the operators.
But I think Claire's got a great point, because I think it goes back to that, you know, what you don't know is what you fear type of thing. And, you know, most individuals, I think when you talk to them, would not even think and understand how high-tech this industry really is.
Yes.
And how that technology is used to safeguard operations and to provide, you know, the comfort of how you're doing your business. So I think, you know, even in this engagement and education, there's an education on just how we actually do our business, the layers of protection, if you will, and the technology that's used in that. And then to your point, the oversight and regulation that's really there, and how out in front Colorado really is on that front.
Yes.
Well, so you both revealed yourselves as experienced professionals. I won't use the O word. But we had a really nice question come in from what I'm going to guess is a younger member of our audience. basically asking for some advice. This is their first downturn.
Yeah.
And you guys have been through many cycles. I've been through a couple. And what advice would you give to somebody who's relatively fresh in the industry? How should they think about the downturn?
Have
Do you want
faith.
to start?
Seriously, you may lose your job. You'll get another one. If you're determined to stay in the industry, another opportunity will appear. Now is the time when incredible innovation happens. Raise your hand to be on the task force that are looking for the next breakthrough on how to lower the cost or improve the recovery. We always come out the other side. It looks like you're riding into a dark canyon. There is a route out the other side. The grass is greener when you come out. The cycles never last as long as the pundits will say, because the bears eventually take over. They take over the airwaves, and it's just going to be terrible forever. It's never like that. Never has been like that. So look at it as I am in the commodity business, a very high-tech business that really needs my expertise, my new eyes, my new way of thinking more than ever.
Yeah, I think Claire brought it up, and she hit on it in her answer to the first question. When you go back and look at some of the downturns we've been through before, and probably the one I remember the most, maybe it's because I was most impressionable at that time, was in the mid-'80s. Mm-hmm. That seemed and felt like the most severe that I can remember. And the difference between now and then, in my mind, and this is what she hit on earlier, is just the vast resource potential that we have in front of us to develop.
Yeah.
I mean, in the right environment, the right place, you can put well names out for 10 years, in front of you in some of these basins with specific locations and an actual well name beside them. I remember in the mid-'80s, if you could look forward 2 years and knew what you were doing, you were thinking you were ahead of the game, type of thing. So coming out of that downturn, you still really didn't know where you were going or how long it would be there.
Very good.
And the difference here is that you're looking forward. You can see, for folks that new entries into this business, I can see a career worth of opportunities for them. Mm-hmm. The other thing I'd say, and we talked about it in some of our town halls as we went around, somebody asked me the question up in Greeley 2 nights ago. So what advice would you have for somebody in this business, for each of us individually? What can each of us individually do? What I came up with, 3 things. 1, act safely all the time, because I always worry in this environment about people getting inwardly focused, and the only way you have a safe operation is if everybody's watching out for everybody else. So that was the first piece. The second one is everybody is a business person. That's all we are. We have training in geology, we have training in engineering, you may have training in finance, but I'm not asking somebody to be that. I'm asking somebody to be a business person, because those are the decisions that we have to make. So always look at the cost benefit and the evaluation and making decisions, and look at it always from a business perspective. How are you improving the business? And then the third thing is constantly look for continual improvement. How do you make something a little bit better? In any environment you can look at that, and that will add up quickly. So, talking to somebody new into this industry, that's what I would tell them.
Yeah. Thank you for sharing that perspective. The longer view is really important in these situations. So I've got a couple other great questions that come in from the audience that are, I think, kind of related, which is, one is, talking about innovating and pushing the envelope. A lot of cost pressure on the service companies, therefore maybe less room for them to innovate and bring additional things to the market because they're so focused on cutting costs. So who's going to be left to innovate? Is it the mom and pops? Is there a place left for the mom and pops? How do you see that landscape shaping up in this kind of environment?
Go back to this long experience. But You know, sometimes the best ideas can come from the most unexpected places. You know, it can come from somebody in the field that just finally has raised their hand and said, I don't understand why we're doing this way. What if you do this? And all of a sudden you make a change and it's a step change. I think the big step change for this industry is going to be how you move from, I'd call it single-digit recovery in these unconventional plays where we're, you know, with the way we've been going, you could foresee 7 to 8% of the oil in place recovery, to moving that over time to double digits, 12, 15% recovery. And where's that going to come from? Who's going to do that? You don't know. And that's why I go back to everybody personally looking for how do you individually make a difference and take something to the next level, because you don't know where that's going to come from. It could come from a service sector. It could come from the E&P companies. It actually can come from somebody out in the field that just has a great idea.
Yeah. What do you think on the mom and pop side? Is that?
Yeah, I mean, I think that that necessity is the mother of invention, right? And so, as I was saying earlier, the market had been rewarding companies for just growth, for gathering assets and growing them as rapidly as they could, irrespective maybe of whether or not they were actually profitable. Now, the markets have said, no more of that. Show me that you have good returns. And I think that that's going to take people back to the basics. And the good news about our industry is that we have so many dials, you know, of applied technology, that there can be breakthroughs that come without having to invent a new battery, you know, which is, you know, frankly, how we got ourselves into this remarkable, you know, look at the abundance of our resource. That was just applied technology using different ways, thinking about it differently. So,
Well, I mean, go back to the drilling example, like you talked about earlier. You know, the market improvement in our ability to drill lateral feet at lower cost that we see now, and the whole time that it takes to spud to rig release on some of these. You know, 3 years ago, we wouldn't have predicted to be here. But that happened because folks started breaking down every element of the activity. And for every element, they started asking themselves, what is the, if you will, technical limit for that? What's the best you could ever do in that one piece? And as you started to improve each piece, it became a cumulative effect.
Right. Yeah, and the scrutiny is intense with where we are with prices, of course. So we've got just a few minutes left. I was maybe hoping to spend just a couple minutes on a couple other policy questions. Let me maybe start with oil exports as something that is front and center in Congress right now. We've heard a little bit about that in the previous days. Wanted to ask you both maybe to share your perspective. And is it going to make a big difference if it happened tomorrow? Is it going to have a big impact?
I don't know what the overnight impact will be. I think the overnight impact will be on the perception of what difference it's going to make. It's a momentum thing, and then it'll play out. I mean, over time, if you have exports, I think, you get more parity between Brent or foreign oil and U.S. at time. But I think it comes back to, you know, why was something put in place that you couldn't export in the first place, and does it still apply? And I'd say the answer is no. I mean, we have this abundant resource now. And then, are we on a level playing field right now? And I think that answer is no. So, you know, what other industry in the U.S., to the extent, is precluded from being involved in a global market? And so, with all that behind you, in my mind, it will happen at some time. Will it happen in the next year or two? I don't know. There's more momentum now than there has been as folks start to understand that. But I believe it will happen over time for all the right reasons.
I was hearing last week, there was a gentleman from the Colorado Farm Bureau, and he said, you know, the fact that we export wheat does not make bread more expensive in Denver.
Right.
I thought, you know, it's kind of a good reminder of some other big commodity markets that maybe give us a fresh perspective. Claire, anything on oil exports and you want to add?
I agree with all that's been said, and I would say, just as with all major changes, it's just got to grind its way through the the various interest groups. And the refiners are starting to come around, because initially it was the refiners saying, hang on, I've got the Jones Act problem, so if you can help me with that. And boy, for whatever reason, the Jones Act seems to be the third rail. I'm not quite sure what it is, but they now are beyond my expertise. That's why we need to get you elected. You can sort through
That's
it,
right.
get that done.
I'm working hard. All right. Well, let's do one more quick one here before the end. Claire, I wanted to start with you kind of on climate change, carbon issues. We talked a little bit about how private equity firms think about above ground risk. Here's another big policy risk that affects all parts of the energy industry. Any thoughts on how you kind of approach investments and how maybe you price that in or think about it?
Yeah, so I would say long term, we're bullish on natural gas because it should be an ever more important part of the energy stack. We are in the camp of we need all of the above. We do need solar and wind, but it's only going to be able to do a small part, a growing part, but still a small part. And natural gas makes so much sense as we think about climate change. I will tell you, I personally, as a geologist, having looked through the records through the years, we know that there are ice builds and ice melts that have nothing to do with, the situation we find ourselves in today. But as a citizen of the globe, I would say carbon pollution is an issue that we should focus on around the globe. We should reduce our carbon emissions. That's just a good thing. But we just have to be thoughtful about what is practical and reach for solutions that are an improvement over where we are today. But, this notion that we can, at huge expense, change the trajectory that we're on, I'm not quite sure I'm personally a buyer of that. Just to be provocative for a moment.
I think it's interesting in Colorado, we're in the middle of this pretty big switch from more and more gas coming into the power generation sector because of people's concerns about carbon pollution. We have 1,000 megawatts right now that's being shifted over due to some legislation from a few years ago. So I think natural gas has a really important role to play in that policy discussion. Dave, anything you want to add?
Just adding on to your point, Chris, I think the more uses for natural gas locally are going to be very beneficial longer term also, and not only for addressing these issues, but just from a pure market. Because as you start moving more gas out of the Northeast, which they have to do, the more you have local use for gas in the Rockies, the better off it's going to be.
Right. Yeah, we didn't even get into the pipeline discussion at all today, which would be another hour conversation, I'm sure. So. Well, fantastic. Well, we're just getting down to our last few moments here, so let me ask the audience to join me in thanking our great panelists, and thanks for making it in this morning to join us for this session. Really appreciate it.
Thanks. Thank you very much, Chris.
Good morning. Let's take one more moment just to thank our panelists again for that amazing conversation. Thank you, guys. Thank you so much. Such insight and advice offered by all three of them. And I really was interested in hearing them talk about outreach and engagement. And so much of that is core